What are you talking about, Money Unshackled lads? I don't invest. A stock market crash doesn't affect me.
Unfortunately, generic office worker stereotype, it does affect you. A stock market crash affects all of us, whether we invest or not.
Your non-investor mates in the office or down the pub don't care about the recent market crash because they don't educate themselves about personal finance, but we're sure our viewers know better. In this video, we show the ways that both investors and non-investors are affected by the stock market crash, just like the one we're in right now. Let's check it out. Welcome to MoneyUnshackled.com, the investment and finance channel and website that sets you and your finances free. I'm Andy, this is Ben, and if you like what we say, hit the like button and click subscribe.
This video is sponsored by LoanPad, the exciting new peer-to-peer lending platform specialising in property bridging loans. If you want to change from the uncertainty of the recent stock market swings, benefit from a more stable capital investment with this peer-to-peer platform, you can receive a steady 5% interest when you invest in their premium account. And this is the kicker. Get a £50 free cash bonus when you open an account and invest £1,000 with them for 1 year when you use the special link on the offers page at our website MoneyUnshackled.com. As with all investments, we have to say that your money is at risk and that you may not get back everything that you invest. We'll put the link to the offers page in the description below, so be sure to check that out. Now, let's get into the video. I don't invest. Yes, you f***ing do. Let's touch briefly on pensions. Almost everyone who works invests in the stock market without necessarily knowing about it via their defined contribution pensions.
600 billion quid is held in defined contribution pensions. Simplistically, if a quarter is shaved off the stock market, then 150 billion pounds off your pensions just went poof. However, don't be too alarmed by this. By the time you retire, the current slump will likely be forgotten.
Though worryingly, most let experts manage their pension pot for them. And experts are stupid. Experts can't help to fiddle, and during a financial crisis will likely try, and likely fail, to improve the situation.
Ideally, your pension will invest in market trackers that do not require experts to manage, in which case you simply ride out the current market slump.
If you're over 50, people approaching retirement are in more trouble. As you approach your agreed retirement date, pension managers will start to de-risk your portfolio by selling your shares and buying bonds, liquidizing your losses. The experts will do this for you. Thanks, experts.
If you're planning on buying annuities with your pension pot, then doing this during a crash is the worst time to do it. Your pot will be a lot smaller than it could have been, and so will be the annuity income that you will lock in for the future.
But if you're not bothering with annuities and plan simply to live off your portfolio's dividends, like we would, the stock market will eventually recover, so your income will likely go up once the crash is over.
Okay, that's pensions done, but that's way off in future land. But what about right now?
Non-investors. Ignoring pensions then, if you don't invest in the sense that you have neither a stocks portfolio, investment properties, or invest in high interest bonds or peer-to-peer lending, you should be deeply concerned right now that you've earned the disrespect of everyone in the investing community for continuing to not invest during the biggest bargain sale the stock market has known for the last several years.
You are making a conscious decision right now to stay poor, to have your wealth and your health affected by staying sat at your office desk for the next several decades, to miss out on being able to retire relatively young and make life about having fun, all by refusing to take advantage of low prices.
Okay, maybe it's just that you don't know how to get started. If that's all it is, then don't worry, investing has never been easier. Mobile phone apps and the internet remove all possible excuses for not having a shares portfolio. For a full explanation of how I opened an investment account and immediately set up a balanced and diversified portfolio of thousands of shares in the global market, go put the kettle on, make a brew, and settle down to watch half an hour of our World Portfolio playlist. We've put a link to it in the description of this video below.
Interest rates. The stock market doesn't directly affect interest rates. However, when governments and central banks see markets crashing, they also can't help themselves but to fiddle. Indeed, this is what we've just seen, with the Bank of England just slashing interest rates from the lofty heights of 0.75% to just 0.1%.
The simplest mechanism a country can use to prop up a falling market is to lower interest rates. The cost of borrowing. This tends to then encourage spending by the population, which then boosts companies' profits and share prices. Usually the stock market has fallen for a reason, like the current health scare, and the stimulus from lower interest rates is introduced to combat that reason. But governments don't like to see their stock markets crashing in any case, as it self-perpetuates panic, and a country's stock index price is seen as an indicator by us consumers as whether we should be panicking or not.
Mortgages and savings accounts. Falling interest rates don't really matter anymore for savings accounts because they were so pathetically low before anyway. You weren't getting rich from your savings account. Anyone with a mortgage will be celebrating the stock market crash, however, as the resulting slash to interest rates could save them hundreds a month.
Peer-to-peer lending. We are massive fans of peer-to-peer lending and have partnerships with many providers that you can check out on our website to give you cashback bonuses when you sign up. But will these high interest investments be giving lower rates now that central banks have lowered their rates?
We assume they would, but we've been receiving many emails this past fortnight from peer-to-peer lending platforms saying that they won't be lowering their interest rates. That it will be business as usual. I guess time will tell.
We think they're seeing this as an opportunity to attract new customers, as the difference between pathetic bank savings interest rates and the high interest rates offered by the peer-to-peer lending platforms is now more stark. And maybe that justifies it to them that they are able to continue to offer the same high rates.
Jobs. Many companies will be smashed into oblivion by the major stock market crash as wider economic panic dries up sales to a level where they have to close down. This leads to redundancies. Flybe was the first major company to go down this time around, and in the weeks since there have been more reports of branch closures at banks and lots of mid-sized companies going tits up.
If our slave wage providers told us that we had to be let go, we'd shrug it off because years ago we decided to become investors and have built up portfolios that we can live off. But many choose not to be financially free and instead choose job security. And sadly, these people will have little protection during a jobs cut. Hopefully their qualifications allow them to get another job quickly.
What to do to protect yourself from a falling stock market? Number 1, if you have a portfolio already, don't sell. Investing is a long-term game, and a loss is only a loss when you crystallise it by selling. Buy more when the price is low.
Number 2, if you don't yet invest, start. Buy now while prices are low, and capitalise on the hysteria in the markets. New investors are often scared off by a downturn, just at the point when they should be paying the most attention.
Number 3, don't panic about your pension falling. Unless you're nearing retirement age. If you are retiring soon, then take control of your pension and make sure that the experts are not selling off at the worst possible time, and be very careful of annuities.
Number 4, don't settle for low interest. Consider taking refuge from the current stock market volatility by investing in a more stable peer-to-peer lending platform for high interest regular monthly income now. Always remember to invest across multiple platforms to reduce your platform risk.
Number 5, F-off fund. Build up an F-off fund or an emergency fund so you can better cope with job losses.
Number 6, diversify incomes. Take steps now to diversify your income streams away from just the one job with interest, dividend, or rent-paying investments and side hustle home businesses, and you'll be better prepared to deal with a crash when it happens. And take the opportunity now, if you're self-isolating at home, to start a side hustle business. Question of the day: how are you feeling about the current stock market crash? Disaster, opportunity, or irrelevance long term? Let us know in the comments below.
Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.